I think investors really should be prepared for the worst. I think I can keep this brief in the sense that a lot of what's going to affect the stock market is the geopolitical situation. But if you got a 401k and you're just buying the S&P 500 index from Vanguard or Fidelity, and it's been going up, and it has been going up, there's no question about that, and you're like, I'll just sit there and watch it go up, be careful. There's nothing I see that's going to make that better. And I remember the 1970s, the stock market peaked. Dow Jones peaked in 1969. It didn't get back to that peak until 1982. Now, okay, 1982 was the beginning of one of the greatest bull markets in history, grant that, but 69 to 82 is 13 years. It went sideways. Now, again, there's volatility and dips and peaks, and I'm not saying you can't make money, but I'm saying that there's a 13-year period when the stock market ended up where it started, number one, around 1,000 on the Dow. And when you adjust for inflation, because we had massive inflation like in the late 1970s, it was still down. So that's 13 years. The U.S. is heading into recession, and we may be in a recession. Everyone's like, wait a second, GDP was up 5%. And it was. That was the number it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. So when those two things, well, consumption, obviously, but people don't realize when wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff. But if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, this is what happens. They slash prices. They do 2-for-1 sales. They just move the merchandise, and particularly in certain areas, stuff goes out of style. The fashion industry is notorious. Who wants last year's, coat or whatever. So then the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. A couple of reasons for that. Number one is, during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then there was Build Back Better, the Inflation Reduction Act, which is actually the greenest scam. I mean, we were we were running deficits of $2 trillion a year for about 4 or 5 years. The total spending was higher than that, but that was the deficit alone was about $2 trillion a year. Nancy Pelosi handing out money. Well, the Americans got used to that. Thanks for the check. And then there was a deferment on student loans. You didn't have to pay your student loans for about at least 2 years, maybe a little bit longer. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low, like 3%. It was up around 13% during the pandemic. It's about a little over 3%, 3.5% right now, which is low. They spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while, but then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25%. So people are tapped out on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards. And they're just backing away. And it's showing up in things like gasoline consumption. It's way down. Gasoline is what economists call, the demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is that sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. You've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, that's not good for stocks. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, credit downgrades to the United States, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown. We're looking at all kinds of geopolitical risks. Stocks are coming down. Then interest rates are going to come down too. But it's important to know that the world economy is slowing down. Germany is in recession. Japan is very close to it. UK, very close to it. Canada, I'm hearing nothing but, bad reports, housing market collapse, etc. China may not technically be in recession, but it's slowing rapidly. The thing with China, it's the second largest economy in the world. They've been growing at like 10%, 10% for over 20 years. When you compound something at 10% for 20 years, you're going to increase it by a factor of 10 or so over that time period, but not now. They're almost certainly below 5. They're going to print 5 because they make up the numbers if they have to. But when you strip out wasted investment, investment that, you build a massive train station with 128 escalators and marble walls, but nobody goes there and the tickets are $10. You can't pay for that. It doesn't produce any wealth. It just creates jobs. So the real estate sector is collapsing. That's been the biggest driver. People are not stepping out to buy houses. They're not taking the bait. Lower interest rates haven't helped. And so China's in a massive slowdown. Whether it's technically a recession almost doesn't matter, because when an economy that big slows that much, it drags the world down with it. So China's not going to save us. Europe's not going to save us. So it's a bit of a stretch to think the U.S. is going to dodge this bullet. If China's slowing down, Germany's in recession, Japan's getting close to recession, Canada, UK, emerging markets, the whole world, plus what we're looking at in the Middle East, the idea that the United States is going to boom while the whole world is going down is just not true. Globalization may be yesterday's news, but it's not over. The supply chains are still global, and we're seeing a lot of problems in the U.S. One of them, by the way, EVs, electric vehicles. People are waking up to the fact that they actually don't work. You can drive around in them, but they don't get the mileage they advertise. And, the resale value of a Tesla is close to zero, because if you buy a used Tesla, the first thing you got to do is spend $10,000, maybe more, on a new battery. So you're like, wait a second, I bought a used car. I got to spend $10,000 to get a battery? Forget it. And the prices are sky high. It's all been subsidized by the government. So that industry is slowing down. The inventories are building up. It's part of what the UAW strike was about. And as I say, consumer hit the wall. So the U.S. is going to follow. The U.S. has been doing better than the rest of the world. The rest of the world's not doing well at all, and particularly China. And the U.S. is going to follow the world into this global recession.